I have spent my life searching for patterns, first in the geometry of space and later in the geometry of markets. The most persistent pattern I observed on Wall Street was not in the data, but in the human mind, a profound, costly addiction to narrative and emotion. For decades, I watched people repeat the same mistakes, driven by the same predictable psychological impulses. They sought a story where there was only a calculation. They looked for a hero or a villain where there was only a complex system of probabilities. This is the fundamental error of the financial world, and it is the error that became our greatest advantage. The conventional wisdom of the market is a comfortable illusion. It is a collection of anecdotes, opinions, and rationalizations that provide a sense of control where none exists. You are here because that conventional wisdom has failed you. You seek an edge. I will tell you how we found ours: by ignoring the noise, by dismissing the narratives, and by listening only to the numbers. The results of this approach are not a matter of opinion, they are a matter of record. The Medallion Fund was not built on a better hunch or a deeper understanding of a company's balance sheet. It was built on the unwavering, systematic application of mathematics. We did not beat Wall Street by being smarter than the analysts. We beat it by being more consistent and more rational than the human element. This required not a change in strategy, but a complete fundamental shift in perspective. The traditional approach to finance is fundamentally flawed because it is predicated on two dangerous assumptions. First, that the market is a rational entity whose movements can be explained by fundamental economic principles. And second, that a human being, with all their inherent psychological biases, is the optimal decision maker. Both assumptions are demonstrably false. The market is not a story to be read. It is a complex, high-dimensional system of interacting variables. When a financial commentator offers a reason for a stock's movement, they are engaging in post hoc rationalization. They are creating a satisfying narrative to explain a random or statistically driven event. This need for a narrative is a deep-seated human flaw, and it is the engine of financial loss. Fear, greed, ego, and the herd instinct are not merely distractions. They are systematic destroyers of capital. The moment a human decision maker introduces their personal judgment into a trading system, they introduce noise, inconsistency, and catastrophic risk. Our thesis was simple, though radical at the time. To succeed in the markets, one must eradicate the human element from the execution of the strategy. The only sustainable edge is a systematic, mathematical, and emotionless approach. This is not a philosophy, it is an empirical conclusion. We replace the flawed human intuition with the flawless logic of the algorithm. This transformation requires three fundamental shifts in how you perceive the market and your role within it. The first shift is the most difficult for the human mind to accept. You must stop searching for a cause and accept the presence of noise. The market is a high-dimensional, noisy system. The daily news cycle, the quarterly earnings reports, the pronouncements of central bankers, these are all attempts to impose a simple, linear causality onto a system that is inherently nonlinear and probabilistic. Consider the analogy of a physicist observing a complex fluid dynamics system. The individual movements of the molecules are chaotic, but the aggregate behavior of the fluid can be described by elegant, predictive equations. The traditional investor is focused on the individual molecule, trying to predict its next collision based on its last. This is a futile exercise. The quantitative approach, the one we pioneered, focuses on the aggregate. We are not trying to predict why a stock moves, we are only trying to quantify the probability of its movement within a very short time horizon. The efficient market hypothesis, which posits that all information is instantly and rationally priced into the market, is a useful theoretical construct, but it is not entirely correct. It is not incorrect because the market misses major fundamental mispricings. Those are rare. It is incorrect because it fails to account for the small, temporary, and statistically exploitable inefficiencies that are constantly created by the friction of human interaction and the mechanics of the market itself. These are not grand, sweeping opportunities. They are tiny, fleeting anomalies. To exploit these anomalies, you must abandon the pursuit of the grand narrative. The signal we seek is buried deep within the noise. It is a faint statistical correlation that persists for a few seconds, a few minutes, or perhaps a few days. It is not a story about a company's future. It is a pattern in the past data that suggests a slight temporary imbalance in supply and demand. The magnitude of the edge is small. We are not aiming to be right 80% of the time. That is an impossibility. We are aiming to be right 50, 75% of the time. This is the concept of high frequency, low confidence trading. If you can make a trade where the expected value is positive, even marginally so, and you can execute that trade thousands of times a day, the law of large numbers guarantees your success. The small, consistent edge, when applied with immense scale and discipline, compounds into an insurmountable advantage. Let us delve deeper into the nature of this noise. In the realm of physics, noise is often a nuisance, a random disturbance that obscures the underlying signal. In the financial markets, however, noise is the very source of our profit. It is the residue of human irrationality, the lag in information processing, and the structural imperfections of the trading mechanisms. These imperfections manifest as temporary deviations from statistical equilibrium. We are not seeking a fundamental mispricing that requires a deep qualitative understanding of a business. We are seeking a statistical mispricing that can be identified and corrected within the span of a trading day. Imagine a simple scenario. Two highly correlated assets, perhaps two different classes of shares in the same company, or a stock and its corresponding futures contract. For a brief moment, due to a large institutional order or a sudden localized panic, the price relationship between these two assets deviates from its historical mean. A traditional investor would not even notice this flicker. Our models, however, are constantly monitoring millions of such relationships. They detect the deviation, calculate the probability of a reversion to the mean, and execute a simultaneous pair of trades selling the overvalued asset and buying the undervalued one. The profit is not derived from predicting the market's direction, but from predicting the correction of a temporary statistical imbalance. This is the essence of statistical arbitrage. It is a pure application of mathematics to a financial problem. The market is not a mystery to be solved by genius, but a puzzle to be solved by relentless, collaborative, and unemotional application of the scientific method. The challenge here is one of scale and data. To find these fleeting anomalies, you cannot rely on a single data stream or a simple spreadsheet. You require petabytes of historical data, sophisticated signal processing techniques, and the computational power to test billions of hypotheses simultaneously. The traditional investor uses a handful of variables: price to earnings ratio, debt to equity, management, quality. We use thousands of variables, many of which would seem utterly irrelevant to a conventional analyst. The time of day, the volume of trades in an unrelated market, the velocity of price change, even the linguistic patterns in news headlines. We are searching for weak, non-obvious correlations that, when aggregated, provide a statistically significant edge. This is why we hired cryptographers and physicists. They are trained to find faint signals in overwhelming noise, a skill far more valuable than any traditional finance degree. This pursuit of the faint signal is guided by a principle that transcends finance: the search for elegance. In mathematics, an elegant proof is one that is simple, surprising, and profound. In our models, elegance is a proxy for robustness. A complex model with dozens of parameters is often a sign of overfitting, a system that perfectly describes the past but fails miserably in the future. An elegant model, by contrast, captures a fundamental, persistent truth about market behavior with minimal complexity. It is a model that has explanatory power beyond the data set it was trained on. We are not interested in the brute force of computation alone. We are interested in the beauty of the underlying mechanism. The most profitable anomalies are often the most elegant ones, simple in their core logic, yet hidden from the view of those who lack the mathematical lens. This focus on elegance is what allows our models to adapt and persist where others fail. I recall a time early in the Medallion Fund's history when one of our most promising models suggested a counterintuitive trade in a commodity market. The fundamental analysts, the ones who read the reports and spoke to the industry contacts, were unanimous in their belief that the trade was irrational. The model, however, was built on a correlation that had held true for 2 decades, a correlation that had nothing to do with the commodity's perceived value. A human trader, even a brilliant one, would have hesitated. They would have second-guessed the model, fearing the professional embarrassment of being wrong against the consensus. But our system executed the trade, and within 48 hours, the statistical anomaly corrected itself, yielding a small, predictable profit. The lesson was clear. The model was right, the human was wrong. The discipline is not in having a better model. The discipline is in trusting the system over your own flawed intuition. The market is a vast, complex machine. The traditional investor attempts to predict the outcome of the machine by reading the instruction manual. We chose to measure the machine's internal mechanics, find the tiny predictable slippages, and exploit them systematically. It is a move from qualitative judgment to quantitative certainty. The second fundamental shift is the eradication of emotion through the implementation of the algorithm. The human brain is a magnificent tool for abstract thought, for creativity, and for survival in a complex, unpredictable world. It is, however, a profoundly poor tool for high-stakes, high-speed, probabilistic decision-making. The human is subject to a host of cognitive biases: confirmation bias, recency bias, loss aversion, and the simple destructive force of ego. These biases are not flaws in character, they are features of the human operating system, and they are incompatible with consistent financial success. The algorithm is the perfect, unemotional executor of a rational strategy. It does not fear a loss, nor does it become greedy after a win. It does not read the morning paper and decide to override its instructions. It simply executes the mathematical mandate. This is why we staff Renaissance Technologies, not with finance professionals, but with mathematicians, physicists, signal processing experts, and cryptographers. We sought individuals who understood the language of data and the discipline of empirical science, not the language of the trading floor. The black box of the Medallion Fund is not a secret formula in the mystical sense. It is a culture of pure empirical science codified into an automated system. The secret is the unwavering discipline to let the system run without human interference. We built a machine that was immune to the psychological forces that destroy other funds. Let us consider the specific psychological flaws that the algorithm systematically neutralizes. Take loss aversion, the psychological finding that the pain of a loss is twice as powerful as the pleasure of an equivalent gain. A human trader, feeling this pain, will often hold on to a losing position too long, hoping for a recovery, or sell a winning position too early, fearing the loss of a paper profit. The algorithm feels no pain. It has a predefined stop loss and take profit mechanism calculated purely on the basis of expected value and risk tolerance. It executes these without hesitation, without regret, and without the ego-driven need to be proven right. Another critical bias is confirmation bias, the tendency to seek out and interpret information that confirms one's existing beliefs. A human trader who has taken a large position in a stock will naturally gravitate toward news articles and analyst reports that support their decision, filtering out contradictory evidence. Our models, by contrast, are agnostic. They are constantly ingesting all available data, and their decision-making process is entirely data-driven, immune to the seductive comfort of a confirming narrative. The algorithm is the ultimate skeptic, constantly testing its own assumptions against the cold reality of the market data. The most insidious flaw is the recency bias, the tendency to overweight recent events. A traditional investor who has just experienced a market crash will become overly cautious, missing the subsequent recovery. Conversely, an investor who has enjoyed a long bull run will become complacent, ignoring the mounting risks. The algorithm has no memory of the last trade, only the full, statistically weighted history of the market. Its decisions are not colored by the euphoria of yesterday's gain or the panic of this morning's dip. It operates in a state of perpetual rational equilibrium. The power of this interdisciplinary approach cannot be overstated. When you bring together a differential geometer, a speech recognition expert, and a computational linguist, they do not see the market as a collection of stocks and bonds. They see it as a vast, noisy data set, a problem in pattern recognition. The methods they bring are not derived from the history of finance, but from the history of science, from cryptography, from physics, from pure mathematics. This is the true meaning of ignoring Wall Street. We ignored its personnel, its culture, and its flawed methodologies. We created a sanctuary for pure empirical thought, where the only currency was a verifiable, predictive model. The result was a collective intelligence that was not only smarter than any single individual, but was also immune to the collective madness of the crowd. Imagine a scenario where a model, based on a vast array of data points, suggests a trade that, on paper, has a 50.75% chance of success. The potential loss is small, and the potential gain is small. A human trader, seeking the thrill of a large win, might dismiss this trade as insignificant. They might wait for a better opportunity, a trade with a higher perceived confidence, which inevitably means a trade that is already widely known and therefore already priced into the market. The algorithm, however, executes the trade instantly. It does not care about the size of the profit, only the consistency of the positive expectation. This is the primacy of the model. The model is the only authority. All decisions must be traceable back to empirical evidence and mathematical proof. If the model suggests a course of action that seems counterintuitive, the human's role is not to question the model's logic, but to question the human's intuition. The only emotion permitted in this environment is the intellectual curiosity to refine the model, to find a more elegant and robust mathematical description of the market's behavior. The process of systematization also allows for continuous, incremental improvement. When a human trader makes a mistake, the cause is often opaque, a bad night's sleep, a moment of panic, a distraction. When an algorithm underperforms, the cause is a quantifiable error in the code or a shift in the underlying statistical pattern. This allows for immediate, precise correction. We are not trying to fix a human's flawed psychology. We are debugging a mathematical equation. This iterative, scientific process is what allows the edge to persist. We are constantly searching for new, small inefficiencies, and once found, they are immediately integrated into the automated system, ensuring that the edge is captured with maximum efficiency and zero emotional friction. The algorithm is the ultimate expression of rational self-interest, unburdened by the very human traits that make us such poor investors. The true genius of the system is not in the complexity of the mathematics, but in the simplicity of the execution. We are not looking for a grand, unified theory of the market. We are looking for hundreds, perhaps thousands, of small, independent, and temporary anomalies. Each anomaly, by itself, is insignificant. But when they are all executed simultaneously with perfect discipline and with the emotional neutrality of a machine, they aggregate into a powerful, consistent, and virtually unstoppable force. The human mind is designed for pattern recognition, but it is also designed for self-deception. The algorithm is designed only for pattern recognition, and it is incapable of self-deception. That is the edge. The third and final shift is the most profound. You must abandon the hubris of prediction and embrace the humility of probability. We do not predict the future. We quantify the probability of outcomes. The market is not a deterministic system, it is a stochastic one. Any claim of absolute certainty in the financial markets is a delusion. Our success was built on the acceptance of this fundamental uncertainty. The focus of our entire operation shifted from maximizing the return of a single trade to optimizing the risk-adjusted return of the entire portfolio. This is the essence of sophisticated risk management. If you have a 50.75% edge on a single coin flip, you will eventually lose all your money if you bet everything on that single flip. But if you bet a small, fixed percentage of your capital on every flip, you are guaranteed to profit over time. The portfolio is not a collection of individual bets. It is a single, complex, stable machine designed to withstand the inherent volatility of its components. This is where the concept of orthogonal bets becomes critical. We build a portfolio where the errors of one model are statistically uncorrelated with the errors of another. If one model is trading currency futures and another is trading grain options, their failures should not coincide. The goal is to create a system where the inevitable small losses in one area are offset by the inevitable small gains in another. The portfolio is designed to be robust, not simply profitable. It is a complex hedge against the very uncertainty we accept as a fundamental truth of the market. The construction of this portfolio is a mathematical exercise in diversification, but taken to an extreme. We are not merely diversifying across asset classes, we are diversifying across strategies. We have models that are momentum-based, models that are mean reversion-based, models that exploit short-term liquidity imbalances, and models that look for longer-term statistical trends. Each model is a small, independent engine of profit. When one engine sputters, the others continue to run. The overall system is designed to be anti-fragile, benefiting from the volatility that destroys less diversified, less systematic approaches. The short-term trading we engage in is not an end in itself. It is the fuel for the engine. The short-term inefficiencies are the source of the small, consistent edge. The portfolio structure is the engine that aggregates these small edges into a massive, stable return. This requires a constant, meticulous focus on position sizing and leverage. We must be aggressive enough to capture the edge, but conservative enough to survive the inevitable, statistically improbable event. Consider the philosophical implication of this approach. The traditional investor is a gambler hoping for a large, unpredictable win. The quantitative investor is an insurance company. We are in the business of selling insurance against statistical anomalies. We take on a vast number of small, quantifiable risks, and because our models have a slight, persistent edge, we collect a premium on every transaction. We do not seek the thrill of the jackpot. We seek the certainty of the actuarial table. This is where the mathematical concept of maximum entropy comes into play. We do not try to force a prediction onto the market. Instead, we use all available information to construct the probability distribution that is least committal to the unknown. This ensures that our models are not overly confident and that our risk management is grounded in a humble acceptance of what we do not know. The traditional investor often operates on a model of minimum entropy, a highly concentrated, highly confident bet on a single outcome. We operate on a model of maximum entropy, spreading our bets across a vast landscape of possibilities, ensuring that no single error can be fatal. This is the intellectual safety net that allows us to pursue the small, fleeting edges without risking the entire enterprise. The greatest challenge in this approach is patience, not the patience of waiting for a stock to rise, but the patience to allow the system to work even when it appears to be underperforming in the short term. The human mind demands immediate gratification and a smooth upward trajectory. The mathematical reality is that success is achieved through a series of small, volatile steps that, in aggregate, trend upward. The discipline is in accepting the volatility as a necessary component of the process, a statistical inevitability, and not a reason to panic or intervene. The market is a casino where you have a tiny, persistent edge. The only way to win is to play every hand systematically, without fail, and with a strict adherence to the mathematical limits of your capital. This is the power of scale and time. Small, consistent edges, when applied systematically and repeatedly over time, compound into insurmountable wealth. The difference between a 50% success rate and a 50.75% success rate seems negligible in a single trade. Over millions of trades, it is the difference between failure and the most successful investment vehicle in history. The compounding effect of this small, persistent edge is the true secret of our success. It is the eighth wonder of the world, and it only works for those who have the discipline to let the mathematics run its course, unmolested by human interference. The market is not a mystery to be solved by genius, but a puzzle to be solved by relentless, collaborative, and unemotional application of the scientific method. We did not outsmart the market. We simply out-systematized the competition. If this analytical approach resonates with you, if you are prepared to trade the comforting illusion of narrative for the cold, hard certainty of mathematics, I ask for two things. First, acknowledge the value of this perspective by liking this video. It is a small, systematic action that supports the continued dissemination of rational thought. Second, I request a comment. Write a single, concise sentence on how you will apply the principle of systematic, emotionless decision-making to your own life, financial or otherwise. Let the comment section be a testament to the power of rational intent. We have discussed the three fundamental shifts required to achieve consistent, long-term success in the markets. First, the shift from narrative to noise, recognizing that the market is a complex system where the signal is a faint statistical anomaly, not a grand economic story. Second, the shift from intuition to algorithm, eradicating the destructive force of human emotion through the unwavering discipline of an automated system. And third, the shift from prediction to probability, accepting uncertainty and managing risk by optimizing the portfolio as a whole, not the individual trade. The true secret to success is not in the complexity of the math, but in the unwavering discipline to apply simple, rational principles in a world driven by irrationality. The market is a puzzle. We solved it by treating it as a problem in mathematics, not a drama in economics. The choice is yours. Continue to chase the narrative or begin to quantify the truth. The interdisciplinary nature of our research is a deliberate choice, a rejection of the siloed thinking prevalent in traditional finance. We sought out the best minds from fields like algebraic geometry, computational neuroscience, and particle physics. These individuals brought with them not just mathematical prowess, but a methodological rigor, a scientific process honed in environments where empirical evidence is the only arbiter of truth. They did not have to unlearn the flawed heuristics of Wall Street. They simply applied their superior tools to a new, complex problem. This fusion of diverse scientific disciplines created a cognitive advantage that was, and remains, virtually impossible to replicate. The market is not a financial problem, it is a scientific one, and we treated it as such.